below the A, if it was below the A, did you get stopped out in any one of these sequences? No, you did not. Now, here's an amazing one, a little nugget that most people and traders don't understand, is when the market forms an AB boundary and it comes down literally to the A and your stop is below the A, or it comes out just a little above the A and bounces and goes back up, that is when you have sideways movement or consolidation that begins to start. Now, once again, look at each one of these levels. Didn't the market make a higher low regardless? See, this was a low, this was a higher low. The market made a higher high and a higher low. At the 382, made a higher high and a higher low. Here at the 618, made a higher high and a higher low. Higher high and higher low at the 786. Higher high and higher low at the 786. But here it made somewhat of an equal low and an equal high, which is how consolidation starts. We've got a great lesson on consolidation that'll teach you how to trade consolidation and profit take. So once again, it's critical you learn all this. Now let's look at it in the market. Here we have an AB boundary, and let's watch how this forms. The market comes down, forms a C at a 382. You see that? Came down, formed a C. Two candles to the left, two candles to the right that are higher. Where then is the projected D? Wouldn't the projected D be at the 1.618? It would be at the 1.618, wouldn't it? So here you have your A, B, C, bullish candlestick formation. Market goes up. Remember I talked about how these two extension levels can act as resistance. Market rallied up, hit this 1.18, kind of held there at resistance before it eventually went to the D target on its time frame, not on your time frame. And that's one of the things that frustrates a trader, is a trader anticipates in getting in the market, having the market bounce at a C, and within 2 hours going to the D. It doesn't work that way. The market moves on its time frame. So one of the struggles a trader has is when they enter the market, they don't properly anticipate how long they may be in the market. If you're looking at 2-hour charts or larger time frame markets and you're buying a C, it could take 3 days for the market to go to the D, when all the time you have an anticipation it's going to hit the D in 2 or 4 hours. It doesn't work that way. So one of the things you may want to do, golden nugget, you may want to try to project how long you anticipate being in the market and say to yourself, I'm not in control of the market. The market's going to do what it wants to do when it wants to do it, and it'll move to its natural Fibonacci sequence on its time frame, not my time frame. Now let's look at it here. Market retraces back to a 618, forms somewhat of tweezer bottoms. If you saw these tweezer bottoms and you got in at a 618 and you put your stop below the A, where would you project your profit to be? You should project your profit to be at the 1.618. You should put your limit to get out about 10 pips in front of that 1.618. So as the market rallies, hits this resistance and then goes up to the 1.618, you profit take from these tweezer tops all the way up to the 1.618. And then what do? You look for a new trade. Now here we got an up AB boundary, A, B, okay? Now here the market comes down. You're thinking to yourself, well, that's probably the C. Once again, go back, look at how it bounced. That past resistance becomes future support. But this market, as long as it's inside the AB boundary, it is trying to decide where the C is going to be. So when you find a C, never forget, the bears could go look for a deeper C, okay? In this case, we thought the C was going to be here, and so if we entered here and put the target at the 1.618, and then the market goes deeper to a 786, if you put your stop right below this candlestick low, you were then stopped out here. And you would have to have the trader's courage to get right back in at this Morningstar to profit take from here to now that it's blue. Where's the target going to be? Blue for blue, okay? Which means if you got in here and you put your stop down below the A and the market went deeper, you have not been stopped out. As a matter of fact, if it goes deeper and you see a bullish candlestick formation appear like here, and it even breaks a counter trend line break, you may want to even buy another lot. This way you have two lots going to the D extension. But this lot that you had projected to go to the 1.618, you're now going to have to adjust its profit back down to the 1.27, blue for blue. And let's watch what happens. We thought that was the C. This is now the C. And here the market goes all the way up to its 1.27 extension. And look how it finds resistance there. Now let's take another look. Here we have an AB boundary. We don't know where the C is going to be. We have an idea that it's going to be deep because of past resistance becoming future support. We think at one time this might be the C. But then the market comes all the way down to the green 8.6. If it goes to the green 8.6, this is as deep as it could go other than to the A. This is your most profitable trade, believe it or not. When the market retraces back to 786, because look at potential risk versus reward. Look at risk. Look at this one. Risk versus reward. See, to where if you got in at a 2-3, this would be risk and this would be reward. It's almost a 1 for 1. But if you get in down here and this is your risk and this is your reward, that's like a 3.5 to 1. So your best trades, golden nugget again, your best trades are to buy 7.86s or an 8.6, placing stops below the A, least amount of risk for greatest reward. And that's what trading is all about. Let's watch what happens here. Market goes green, profit take 10 pips to the green extension. So in the next lesson, we're going to be talking about what's going on inside the AB boundary and how the market rallies to the next D extension level. Now let's talk about what goes on inside the AB boundary between the bulls and the bears. What we have here is we have the market in an uptrend creating an up AB, and we're anticipating the market to complete an ABCD. Now you got to keep one thing in mind. When the market's trending, it is going to create a higher low, which means the C will be somewhere higher than the A. And so what you have is you have your AB boundary, you have your rally, and then you have your retracement right here. And one thing we learned in past lessons is usually the market will go to the deepest level of past resistance. That's that golden nugget I've shared with you, that's where the C will probably be. But what you need to understand is what takes place inside the AB boundary is literally a war between the bulls and the bears because they're fighting for control. See, if we're in an uptrend, the bears are going to try to take the market all the way back to A. But the bulls are literally going to fight and support the price the closer it gets to the A. And so what you have here is in your first move, you have what is called a potential super shallow retracement. That's where the market doesn't even come back to the 2-3 Fibonacci number. It literally comes short of it. The market is fast and aggressive. Could be a fundamental announcement day that makes it move this fast and aggressive because it didn't even come back to the 2-3 or it U-turned above the 382 or the 2-3. It literally went through the 1.618. Now the second one is also considered a super shallow retracement. Now what we learned in previous lessons is that the market predominantly comes back to the 382 90% of the time. So in this super shallow retracement, this action, this price action that you see will only happen about 10% of the time. If you see a super shallow retracement where the market comes down just like this and rallies above the B high, it now has a 90% chance of going to the 1.18, 1.27, forming a bearish candlestick formation. We've learned that these charts talk, they just communicate via candlestick formations. Forms a bearish candlestick formation, which tells the trader this is going to go back down because the market never hit the 2-3. The market's going to go down and at least hit the 2-3, may even go deeper inside the AB boundary. But here you see it came back, hit the 2-3, and then bounced and went up. The third way the market can literally retrace is it can come back to the 2-3, rally straight up, can come back to the 382, rally, go straight up, can come straight back to the 5-0, then rally and go straight up, can come back to the 618, then rally, reds for reds, can come straight down to the 786, form that bullish candlestick formation, rally, go up to the 127, or come back to the 786 or the 86, green for green. And so you got to pay attention where this thing is going to be forming its candlestick formation, its counter trend line break, past resistance become future support. Those are the technical skills that you're learning to help you become that better trader. The next way this market can retrace is what's called a sub-ABCD retracement. It's where the market comes down, bounces off a Fibonacci level, starts to rally back up. Now look at how it started to rally back up, forms a bearish candlestick formation. Now here's a golden nugget. Anytime the market bounces inside an AB boundary, starts to take off to the B high, if it forms a bearish candlestick formation near the B high, that is a sign the market's going to go deeper inside the AB boundary. You see, in any one of these, as the market started to rally on its way up, it didn't form any bearish candlestick formations. This was pure rally. But see, the market came down, bounced at a 382, started to rally, but formed a bearish candlestick formation. Look at here. Didn't form any bearish candlestick formations. Here, bounced at a shallow retracement, rallied up, did not form a bearish candlestick formation until it hit the 127, which is a sign that it's going to go deeper, as we discussed before. Here, the market comes down, bounces, goes up to the 382, and then it starts to come down and bounces at a 618. There, breaks the counter trend line, candlestick formation. You have a sub down A, B, C, D. Now the next way the market can retrace. Remember, this is a financial war between the bulls and the bears. Bulls and bears are fighting for control. And as a matter of fact, the closer it gets to the A, the more intense the war. But the market could literally come down, bounce at the 2-3, come down, bounce at the 382, come down, bounce at the 5-0, come down, bounce at the 618. Eventually, it's going to bounce somewhere. Now, you can see here, if you bought a candlestick formation there, bought one there, bought one there, bought one there, you know, you ended up getting stopped out 1, 2, 3 times before it finally paid off. But regardless of where you got in, if you placed your stop below the A, on none of these have you been stopped out. Now, this can happen. And what usually happens is if you buy a candlestick formation here, another one here, another one here, you don't have the courage to buy another one down here, and you miss the move. And so here the market bounces at the 786, blue for blue. Here, this is called whippy-lashy, when this market just starts to go everywhere. It just rallies up, comes back down, rallies up, fakes a trader out. And so once again, if you put your stop, now listen to me, if you put your stop anywhere inside the AB boundary, you increase your chances of getting stopped out by 80% prematurely. And if you put your stop below the A, in an upswing, you increase your chances of not getting stopped out by 80%. Put your stop anywhere inside an AB boundary, increase your stop to 80%. I'm repeating this again because this is important information. Put it below it, decrease it by 80%. So it's really critical that you learn where to place your stops. Now let's look at this in the market. Market forms an up AB boundary, comes down to an 8-6. Now look at how it does an A, B, C, D retracement. See, this is where the bulls and bears are fighting for control. Because it bounces at an 8-6, where's the projected target? The 118. Look at here. Here the market starts to take its time. Look at how many candles this is. This is what's called turtle price movement. You know, it's very slow, very precise, but look at how it just found a huge level of support right down here because it's bouncing above the 618. Target is 1.618. But the market can literally stay inside this AB boundary, and look how small these candles are. You know, you don't have huge candles like this anywhere inside this. This is what you call turtle price movement. It's slow and precise. So here we have your rally, your retracement. Now let's talk about extensions and how the market can move towards an extension. One of the things you need to understand is that the extension does not start until the market is above the B high. As long as the market is inside an AB boundary, it has not started to work on the extension. The extension becomes the extension when it goes above the B high. So let's look at some charts here. We have all the various retracements, okay? Can go deeper, higher. But what can happen is this market can bounce to the 2-3, go up to the 127, come back to the 382, and then straight take off with a straight rally to the 1.618. The market can come down anywhere to the 2-3, 382, 50, 618, go straight up to the 1.618. The market then can come down to any one of these levels, and as it begins to rally, it can create another up sub A, B, C, D before it hits its projected D. The market can come down here, go up to the 127, retrace back inside the AB boundary, go back up before it hits resistance, pulls back a little bit before it hits its target. Once again, you've got to monitor where the market bounces. Red for red, blue for blue, green for green. The market could come down here. Now look at how this right here created a sub A, B, C, D. If you get confused with how this market's moving, you might do yourself a technical favor since you're anticipating an ABCD price movement to take place. You may draw a line from A to B, another straight line down to like the 618, and another straight line up to the 1.618. So regardless of how it retraces, as you have all this price movement going back and forth, you're keeping up with that solid line because all this price movement right here is called retracement. And all this rally, all the sub A, sub B, sub C, sub D, sub A, sub B, sub C, sub D, sub A, sub B, sub C, sub D, sub A, sub B, sub C, sub D. All these subs are participating in the C to D price movement. And then, of course, you have your whippy lashy. But see, if you have to where the market, you have your lines drawn, and you have a black line that says A to B, another black line that comes down to like the 618, and another black line that goes up to the 1.618. When you start to see all this whippy, lashy, nasty price movement, you can start to say to yourself, well, this is just the market going crazy inside the AB boundary. This could be a lot of fighting between the bulls and the bears, you know. But the plain old bottom line is all this price movement is participating in the market moving in a Fibonacci sequence. All this is the market, once again, regardless of how it retraces and regardless of how it goes to the extension, is moving in a Fibonacci price sequence. So let's look at it in a chart, okay? We have the market, retrace back to a 5-0. Here it came up, went higher than the 127. I mean the B high, went up to the 127. Now, one of the things, here's another golden nugget you may want to write down in your book. When the market forms a high at the 127 and then retraces back into an AB boundary, I want you to see this, A, B, C, D. When it forms a high and the market starts to rally above the high, it now has a 90-95% chance of going to the D. And so you need to understand that. Now here we have an A, a B. You have all this price movement inside the AB boundary, and you have now past resistance to become future support. You have a C, did not, came close to the blue. Now this is important you understand this. It has to touch the blue before you use this as your blue target, okay? So since it did not touch the blue down here, where then is the extension gonna be? Because if you think, well, it's gone to the 786 because it penetrated the 618, and you profit take right here, blue for blue, but it still continues to go up here, you could walk away from a lot of pips. And so once again, the market, the candlesticks have to touch the Fibonacci number. And so since it did not touch here, the target is the 1.618 D extension. And this is very fascinating about how the market works. And all I want to say is the more you take the time to really understand how this market moves, will really participate in helping you become that better trader, especially in the Fibonacci sequence. Take